Welcome to my channel, The Entrepreneurial Mindset. I am your host, Jay Berman. Today is March 8, 2024, and today's presentation is called, Is Your Business Idea a Good Investment? Today's learning objectives: business ownership, which is your investment; the entrepreneur, both the business owner and an investor; the income statement, which is also your financial plan or financial model; your startup costs or your initial investment; your required rate of return; and the net present value, which is either going to be positive or negative. So what is an investment? Well, it begins with an initial amount of money. So for example, if you're going to buy a house, your down payment would be your initial investment, or perhaps you're putting money into a mutual fund. An investment also allows for additional amounts of money, either on an annual or monthly basis. An investment does entail risk. In other words, you can either make money or you can lose money. An investment has no guarantee of a particular rate of return. That's quite different than, let's say, a savings account where the bank gives you a guaranteed rate of return of 1 to 5%, or a certificate of deposit. Examples of investments are stocks, bonds, mutual funds, precious metals such as gold, silver, platinum coins, and of course, real estate, your home, apartments, commercial property. So the question is business ownership an investment? And I would say, yeah, it is, absolutely. It begins with initial investment, which would be the initial amount of money. You can continue to put more money into a business. Does it entail risk? Absolutely. Your business can make money. It can also lose money and lead you to bankruptcy. There is no guarantee of a particular rate of return when it comes to business ownership. So who is an investor? Well, an investor can be a person, just like you and I, or it could be a company, partners, shareholders. An investor is somebody who commits money and expects a certain rate of return. An investor seeks income and wealth with that investment. An investor tends to have a certain amount of risk tolerance where they want to minimize their investment losses and maximize their investment returns. So is an entrepreneur an investor? Sure. An investor can either be a single person like you or I, or they can form a partnership with other co-founders. An entrepreneur does commit a certain amount of money and they expect a certain amount of rate of return. An entrepreneur seeks income, whether it's salary or maybe perhaps wealth with that investment. And to be an entrepreneur, you have to have a certain amount of risk tolerance. So yes, you want to minimize your losses and maximize your returns. So what is considered a good investment? Well, it should achieve your financial goals. What are your financial goals? Well, number one is to increase your income. In other words, more money in your bank. Another financial goal would be to increase your wealth. Now, wealth is an asset that increases in value long term. So the question is whether your investment must earn a good rate of return to both accomplish an increase in your income and an increase in your wealth. And then you have to ask yourself, will your business idea be a good investment by providing you a good rate of return that will increase your income and increase your wealth? So to evaluate your business idea as an investment, we need to take a look at your financial plan, but specifically the financial plan part of your business plan, which is also your financial model. We need to take a look at your income statement, which is your operating income for the first 5 years of your business. We need to look at your initial investment, which is your startup costs. We need to look at your required rate of return. Is that 10%, 15%, 20%, 25%? And then we're going to use the net present value calculator, which I'll explain later. So what is an income statement? Well, an income statement has these main categories. Your top line is your revenue. Then below that is your cost of goods sold, or COGS. Then your gross profit margin, your operating expenses, your earnings before interest and taxes, EBIT for short, or it's also called operating income. interest, interest going to a bank. So if you have any loans, taxes, which of course go to the federal government, and then of course your bottom line is your net profit or net income, or it could be a net loss. And this is an example of what an income statement looks like, your financial model. So you notice you got your revenues, your cost of goods sold, your gross profit, your years 1, 2, 3, 4, and 5, your operating expenses. And again, this is a generic income statement. So these are your major categories, owner's salary, which would be your salary, employee salaries, if anybody working for you, any kind of office rent, marketing and advertising expenses, insurance and legal fees. You add all those up. Those are your total operating expenses. Then there's your earnings before interest and taxes, which again is your operating income, also called cash flow, interest to the bank, your taxes, and your net income or net loss. So what is revenue? Well, revenue comes from customers, from buyers. So what is a customer and a buyer? Well, a customer or buyer is someone who agrees with you that your products are better than your competitors. And your agreement is persuasion, which equals payment. So a customer agrees that your products are better by paying for your products. So the question is, what is a product? Well, it can either be a good or a service. A good is something that is tangible, that the customer takes ownership. So, you buy a shirt, or you buy a car, or you buy a house, you're taking ownership. A service is an intangible experience that customer rents. So, for example, you might rent an apartment, you might rent a car, you might, your cell phone service is an example of rent. Insurance, when you pay insurance premiums on term policies, that would be considered rent. So revenue for goods would be the price of the good times the number of items sold. And revenue for services would be the price of the service times customers. So let's say you have 100 customers and they're paying $50 a month, then that'd be $5,000 a month in revenue for services. So what exactly is cost of goods sold, or COGS? Well, it's primarily applicable to selling goods, physical items that people take ownership of. The cost of goods sold is the cost of producing or manufacturing what we call inventory. Now, what is inventory? Inventory is what we call unsold goods. So you go to a retail store like Walmart, or Barnes & Noble, or any big retailer, or even a small retailer, and the items you see on the shelf, that would be considered inventory. Now, when you take an item off the shelf, like at a grocery store, you're buying food, you're buying canned goods, put the canned goods in your shopping cart, and then you go to the cashier, you buy the goods, you buy your food, that inventory becomes sold goods. My recommendation for cost of goods sold would be 50% or less of selling price. So if you're selling something for $100, your cost of goods sold should be 50% or less, or $50 or less. And to calculate your cost of goods sold, you take cost of goods sold, divide that by revenue, and again, that should be 50% or less. Your gross profit or gross profit margin is revenue minus cost of goods sold. Your gross profit margin equals gross profit divided by revenue. Again, recommended gross profit margin should be 50% or more, because your cost of goods sold should be 50% or less. And your gross profit margin plus cost of goods sold should equal 100%. Operating expenses. And as I mentioned earlier, your operating expenses would be salaries and benefits. So, for example, a benefit would be like health insurance, office rent of commercial space, if you need a separate office for your business, promotional services, marketing, advertising, sales, legal services. You might need licenses, regulatory compliance. Imagine opening up a restaurant and having to comply with all the regulations required to open up a restaurant. Could be very expensive. There's other insurance. There's auto, there's business, there's product liability insurance. They could if you go into accept credit cards, and the vast majority of businesses accept some sort of credit cards. American Express, Visa, Mastercard, which is what MC stands for, Mastercard. You would have to pay credit acceptance fees. I believe Visa and Mastercard, they charge around 3% um, for revenue. I think American Express charges around 5%. And then there's ACH payments where you're actually debiting a person's checking account. So they're using a debit card. You can probably do that. I would talk to your bank to make sure that you can accept ACH payments. In other words, you're debiting directly from people's checking account. People may not feel comfortable doing that. They may prefer to pay by credit card, and therefore you do have to calculate the credit card acceptance fees. So earnings before interest and taxes, which is your EBIT. EBIT equals gross profit minus operating expenses. EBIT equals your operating profit or operating income, which is your cash flow. And again, you need to calculate your EBIT, your earnings before interest and taxes, for the first 5 years of operation. So you're basically doing, forecasting. So your startup costs, which is your initial investment, I would recommend anywhere between 6 to 12 months of your first year's operating expenses. Your initial investment might include machinery and equipment, which you can either buy or lease. You may need transportation, so cars, trucks. Again, you can buy or lease. Any kind of renovations. So if you're planning to open up a retail store, a cafe, bar, restaurant, maybe a hotel, bed and breakfast, the cost of renovations. Materials and supplies, any kind of inventory, because you always want to have goods available when the customer demands. So you may have to do some sort of demand forecast. I personally don't like to buy from websites where they advertise a product and it's sold out. So that's probably not a good thing. So you always want to have product available for customers to demand. You might have, again, legal fees, legal expenses, licenses, certifications, again, getting back to regulatory compliance. I would recommend once you add up all your startup costs, whatever that amount of money is, I recommend that you double it. So if you need $50,000, you probably need closer to $100,000. It's always good to raise more money than you need than less. So again, whatever your startup costs, and again, your startup costs can be as low as $500. It can be as high as $1 million. It depends on what business you're starting. So whatever that initial investment should be, I recommend that you double it. So let's get to the net present value. This was from the Harvard Business Review. It was probably the easiest definition of what a net present value is. So the net present value is the present value in today's dollars of the future cash flows at the required rate of return of your project, which would be your business, compared to your initial investment or startup costs. By looking at the money you expect to make from the investment and translating those returns in today's dollars, you can decide whether the project is worthwhile. Now, the net present value was formalized and popularized by a gentleman named Irving Fisher in his book, Rate of Interest, which was published in 1907. So it's an important finance tool that's been around for over 100 years and has got a lot of credibility. NPV has been included in finance textbooks since the 1950s, and the NPV is usually taught in finance courses in business school. I know when I was getting my MBA, my finance professor really grilled into us the importance of the net present value to decide on whether an investment is worthwhile or not. So we need to use the net present value calculator, and there are plenty of them on the internet. You don't have to calculate the net present value by hand anymore. This is my favorite net present value. And these are the things that you're going to need. So again, your startup costs, which is your initial investment, your earnings before interest and taxes for years 1, 2, 3, 4, and 5. Your rate of return, it can be 15%, 20, 25%. I know these rate of returns are pretty high, but then a small business, an entrepreneurial venture, is a pretty high risk investment. So you probably want to have a really fairly high rate of return. And then the net present value, your results are going to be two. One's going to be positive, the other one's going to be negative. So if it's a positive NPV or net present value, that means your business is going to might be a good investment, assuming your earnings before interest and taxes projections are realistic and attainable. Now, you could get a negative net present value, which is not necessarily the end of the world. It just means that at those level of earnings before interest and taxes, your operating income, your cash flow, it may not be a worthwhile investment. But there are a number of things that you can do to get the net present value to be positive. You may have to increase your revenue, which means selling more. You may have to lower your expenses. You may have to lower your initial investment, or you may have to lower your rate of return. And this is what the net present value looks like on the internet. Again, you put your initial investment here. Here's your discount rate. I usually start up at 25%. And then here you put in your cash flows for year 1, year 2, year 3, year 4, and year 5. You press calculate, and your net present value, again, will either be positive or negative. Again, if it's positive, it's a good sign that your entrepreneurial venture might be a good rate of return. It's a negative, again, not necessarily a bad investment. You just have to do any of the strategies I mentioned earlier, which means you're going to have to increase your revenue, somehow lower your expenses. Maybe instead of hiring 5 employees, you only hire 3. You may have to lower your initial investment. So maybe instead of 50,000, maybe 40,000 might be more realistic, or you may have to lower your rate of return. So if you start up at 25%, maybe go down to 20% and go down below 15%. And that's pretty much it. So please, if you like this presentation, please subscribe to my channel for more educational content about entrepreneurship. Any questions or comments, please use the comment section to contact me. And thank you for watching. And I hope to see you soon.